Okay, let's do some Chapter 9 practice. We're going to start with some of the basics of flexible budgeting. So let's take a look at exercise 9-1 shown on the screen here. So in this problem, we're looking at Puget Sound divers. We know they're a company that provides some diving services in the Puget Sound area. We have their planning budget shown here in the box. And as you know from your reading, planning budgets are prepared at the expected or budgeted level of activity. We contrast that with our flexible budgets, which are prepared at the actual level of activity. And we note below the box here that during May, Puget Sound divers' actual activity was 105 diving hours, slightly more than the 100 hours they had expected. So our requirement here is to put together a flexible budget for that same period. So we're Puget Sound divers. We're creating our flexible budget, and this is for month end 5/31. Now we'll go ahead and note the actual diving hours at the top. And again, that's 105, slightly more than the budgeted hours of 100. So our first line is revenue, and we know that from the box here, the revenue formula is $365 times the number of hours of diving. So our total revenue for the period in the flex budget should just be that $365 times the 105 actual hours that were worked. Then we're going to follow with all of our expenses. So we've got wages and salaries, and we know from our cost formula there that that's a mixed cost. Right? $8,000 is a fixed component plus $125 per diving hour on top of that. So our total wages and salary expense in our flex budget should be the $8,000 fixed cost plus $125 times, again, that 105 actual diving hours. We'll continue on and look at the supplies expense here. That's a variable cost because the cost formula just expresses $3 times the quantity of diving hours. So all we need there is that $3 times the 105 actual diving hours for the period. Equipment rental is the next cost to consider. And again, that looks like it's mixed. $1,800 fixed, plus we'll add to that $32 per diving hour, again times the 105 actual diving hours. Just a couple more here. Insurance is entirely fixed. So remember, with fixed costs, we don't flex them in the flex budget. They're assumed to be constant within our whole relevant range, and we're assuming that our flex budget here is still within that same relevant range. And then finally, our miscellaneous expense, which again is mixed, so $630 regardless of the activity level, plus $1.80 times the 105 actual hours worked. We'll follow suit and get our total expenses summed up just as they did in the box there, and that's just the sum of these 5 expenses here. And then our net operating income, just our budgeted revenue. I'll put in the numbers this time rather than the cell reference, $38,325 from right here, minus that total expense of $30,819, and our net income would be budgeted at $7,506. Again, we would expect that to be a little bit higher since our actual level of activity was a little bit higher than our budgeted level of activity. So we'd expect things that change with volume at all, like our revenue, any of our mixed or variable costs, to all increase relative to our planning budget. So to wrap that up, our flexible budget should flex for the actual level of activity all of our income statement items here that change with volume. So our revenue, any of our expenses that were variable or mixed, so everything except insurance in this case, and then again we'd get our net operating income total at the bottom. Okay, so let's look at exercise 9-4. preparing a flex budget performance report. So the company for us to consider is Vulcan Flyovers. They do tours of Mount St. Helens out in Washington. And we were given data for this month end, July 31st. We know actual results for the period. We also know the company's flex budget and their planning budget. So I've gone ahead and laid that information out in the spreadsheet here just so we have something to work from. We also are told the company measures its activity in terms of flights and that customers can buy individual tickets for these overflights or can hire an entire plane for an overflight at a discount. So we want to consider what's potentially causing changes in their results as a result of changes in activity and other things. So the first requirement is to prepare a flex budget performance report for this month of July. And we want to include basically all of our variances. So our revenue and spending variances, that's one category, and then our activity variances as well. So looking over here at the results side by side, we know that activity variances come about because of differences between our flex budget and our planning budget. Remember, our planning budget is prepared at the expected level of activity for the period, whereas the flex budget is prepared at the actual level of activity, but based on the same revenue and cost formulas as the planning budget. So any difference between those two will be related strictly to differences in volume or activity between what was expected and what actually occurred in the period. We're trying to isolate those changes. Over here on the other side, we know that any difference between the flex budget and our actual results, those will be our revenue or spending variances. So those will be differences caused by something other than changes in activity. So it might be the cost of an input, like the price we have to pay for some material or supply, or what we have to pay in terms of payroll taxes for our employees, something that changed mid-period maybe. So we'll talk about other examples of those as we go. But for now, let's kind of just remember that revenue and spending variances, again, not related to any difference in activity, because we're looking at the same level of activity between those two sets of results, what actually happened. Okay, so let's just start thinking about some differences here in terms of our activity variances. So we know that we flew or conducted 48 flights during the period, but had expected to do 50. So we can already know what direction our activity variances are going to be going. Right? From a revenue standpoint, that stuff should be lower or unfavorable. From an expense standpoint, that stuff should be lower or favorable, again, because we conducted fewer flights than we expected to. So let's take them one by one here. Revenue was expected to be $16,000 in the planning budget. Our flex budget shows $15,360. So we'll just get the difference between those two, or $640. And again, because the revenue in our flex budget is lower than our planning budget, we'd say that variance is unfavorable. And again, we would know that distinction before we even found a number here, because we conducted fewer flights than we expected to. Similar idea here for all of our expenses. So I'll use the cell references this time. Planning budget minus flex budget, the difference of 164. That expense is lower than the planning budget, so we'd say it's favorable, but again, it's stemming entirely from the fact that we had lower activity than we expected. Same idea for our remaining costs. Fuel, $46, favorable. Airport fees, since that changes some with volume, $76, favorable. Depreciation, again, that varies with volume, so $14 variance is favorable. Office expense, that looks like a mixed cost, right? A portion that's fixed and a portion that varies. So since some of it varies, that's also going to have an activity variance, $4 favorable. We might as well find a total at the total expense line, $304 favorable. And then we can do the same for income. $3,560 in the planning budget, minus the 3,224 in the flex budget, that 336 we'd say is unfavorable. Right? Net income lower than the planning budget, so unfavorable. We also could find that difference by netting out the $640 unfavorable revenue variance and the $304 favorable expense variance. The net of those two, $336, the unfavorable was greater than the favorable, so that would have been another way we could have found that total. Now let's look at our revenue and spending variances. Again, these are going to be caused by differences, something other than changes in activity. So let's start with revenue here. Our flex budget was $15,360. Our actual results were $13,650. So that $1,700.10 difference is unfavorable. Right? Our actual result was lower than what it quote unquote should have been given our actual level of activity. So that's an unfavorable variance at the revenue line. And we'll come back to that in just a couple minutes. We want to find differences for all of our expenses here. So the difference in wages and salaries, $494. That's greater in the actual result than it is in the flex. So that's also an unfavorable variance. Fuel, $12.60 minus $11.04, $156. Again, higher in the actual result, so that's unfavorable. Airport fees, $24.74 minus the $23.50, $124, but that's lower than the flex budget, so we'd say that's favorable. No difference for depreciation. Office expenses, $460 minus the $286, and there's $174. Again, it's greater in the actual than it should have been given the flex, so that's unfavorable. Total expenses, $12,836 minus the $12,136, $700, again unfavorable. And then our net income, we already know where this is headed, but this big difference of $2,410, that is in the unfavorable direction. Now we knew that was coming given that our revenue was so much lower than it quote unquote should have been in the flex budget. A lot of our expenses were also higher than expected. We only had one that was a little bit lower than expected given our actual level of activity. So there's our big difference in net operating income. Now the second part of that asked us to determine which of the variances should be of concern to management and why. So there's a few to think about here. On the revenue line, remember our flex budget said, well, given that we conducted 48 flights, our revenue should have been $15,360. But the revenue we actually earned was $13,650 for a pretty significant difference, more than 10% in the unfavorable direction. So that would certainly be of concern. One thing it told us is that customers can buy these tickets for overflights or hire an entire plane at a discount. So maybe that's what happened here. Maybe these flights were these overflights and we had to discount the price somewhat unexpectedly. That could be one possible answer there. Wages and salaries was unfavorable as well. We don't know exactly what's happening there. We paid a bit more than we expected to our employees, so maybe we had to pay some overtime. Maybe payroll taxes changed and were higher this period for some reason. Similar idea for fuel. Maybe the cost of gas went up. That difference is a little more than 10%, so it's potentially of concern. It's not insignificant for sure. Airport fees were a little lower, but not even by that much, right? Roughly 5%, so it's probably not of great concern. And then our office expenses were also a bit inflated. And that's not an inconsequential amount in the grand scheme of things. $174. So who knows what happened there as well. Maybe there was some employee theft. People stole paper clips. Right? Maybe we wasted some supplies somehow. We don't know any more about it. we know it's potentially something to look into. So overall, yeah, our net income was significantly lower than it should have been given our actual level of activity. So we'd want to investigate some of those variances we spoke of. Next, we're going to take a quick look at exercise 9-5, preparing a flex budget with more than one cost driver. For most of you, this is probably fairly intuitive from the reading, but I just want to make sure we're extra clear on flexing budgets when we have more than one cost driver to consider per cost. So here we were given this example of a tour company that operates tours of glaciers in Alaska. We've identified two cost drivers, the number of cruises and then the number of passengers on cruises that we use for budgeting and performance reports. So up to 80 passengers can be accommodated on the boat. And here's some information about all our cost formulas. We also know that, for example, the vessel operating cost should be this $5,200 per month in fixed costs, plus $480 per cruise. So that could be port fees and all types of things that don't depend on the volume of passengers, plus $2 per passenger. So that could be food cost and things, again, that might vary with volume of passengers. It also tells us the company's sales should average $25 per passenger. And in July, they provided 24 cruises and a total of 1,400 passengers. So we're going to look at the flex budget again for this month end of July. So there's not a lot of difference between this and our single driver flex budgets. We just need to make sure we account for the multiple drivers wherever appropriate. So first line is going to be revenue again, and the only information we have about that is this should average $25 per passenger, and it told us we ran 24 cruises and a total of 1,400 passengers. So we'd expect that revenue to be $35,000. Now first up we have our vessel operating costs, and again that is a mixed cost. We have a fixed component and then a variable component that varies based on the number of cruises and the number of passengers. So our formula there is the $5,200 in fixed costs plus $480 per cruise times the 24 cruises we ran plus an additional 1,400 passengers times $2 per passenger. So again, the variable component depends on two things in terms of volume: number of cruises and number of passengers. So that total cost in our flex budget should be $19,520. We had advertising costs. Those are entirely fixed. So remember, in our flex budget, we don't flex fixed costs. We assume they are staying constant per our assumptions about fixed costs in general. We also had some admin costs to consider, and that again was mixed with the variable component depending on both measures of volume. So we've got the $4,300 fixed component plus $24 per cruise times the 24 cruises we ran plus $1 per passenger times the 1,400 total passengers that were on our cruise ships in this period. So total admin costs in the flex budget, $6,276. And then finally we had insurance, which looks like it's entirely fixed at $2,900. We might as well get our total expenses, just the sum of those four individual expenses, two of which changed with volume, two of which did not. And the net operating income in our flex budget then would be our revenue of $35,000 minus those total expenses of $30,000 and change. So given our actual level of activity of 24 cruises and a total of 1,400 passengers, our budgeted net operating income in our flex budget is this bottom line of $4,604. Okay, next up we're going to look at the foundational 15 for Chapter 9, which is really a comprehensive problem with a whole bunch of different components asked about it. And it incorporates many of our different flex budget concepts from this entire chapter. So the setup said Adger Corp's a service company that measures its output based on number of customers. We know a whole bunch of information about expected revenue, employee salaries and wages, travel expenses, and other expenses. We also know that when preparing the planning budget for this particular period, the company had estimated it would serve 30 customers. However, during May, the company actually served 35. So the first requirement is to find out what amount of revenue would be included in Adger's flex budget. So we're going to go ahead and do all of our setup up front, knowing that we're going to be looking for information from the flex budget, the planning budget, the actual results, and then our variances as well. So thinking about our overall performance reports that incorporated both our flex and planning budgets and then our actual results, I'm going to lay out those column by column. So here's our actual results, here's our flex budget, and then here's our planning budget over here on the side. So I'm going to leave a little room in case we want to add some notes here. Let's think about our revenue first. So the first question asks us specifically for the flex budget here, so I'll do that one first. We know that revenue is expected to be $5,000 per customer served, and there's no fixed element of revenue. We don't collect some kind of contractual amount from customers. Everything's based on volume. So that revenue for May should be $5,000. And since we're in the flex budget, we want to flex that by the actual number of customers served. So times the 35 actual customers for the month that was noted in the setup. So $175,000. I'm going to go ahead and fill in revenue for the other columns as well while we're here. So the actual total was already given at $160,000, so we can plug that in here. Now in the planning budget, it would be using the same $5,000 per customer revenue component, but we'd want to multiply that times the expected number of customers served of 30 as opposed to that actual number of customers served. So in our planning budget, that revenue would be $150,000. The second question asks what amount of employee salaries and wages would be included in the flex budget. So we're going to look at some expenses here next, and since salaries and wages is the first one up, that's pretty good timing for us. So I'll start with the flex since that was the question. We know that this is a mixed cost. There's a fixed component that doesn't change with activity, and then there's a variable component that does. So in our flex budget, employee salaries would be the $50,000 fixed component plus the $1,100 variable component multiplied by, again, be careful, the actual number of customers served of 35. Our flex budget should be actual, actual, actual. In fact, let's go ahead and note that up here. This is number of customers. Our actual results will reflect, of course, the actual customers. Our flex budget should reflect, the actual number of customers. And the planning budget should be the only one that reflects the expected number of customers of 30. So back to our salaries and wages. The actual total again was given, $88,000. We'll fill in the planning budget amount over here. Fixed $50,000 plus the variable component of $1,100 multiplied by, again, the expected number of customers of 30. And there we are, $83,000. The next expense was travel, and then we'll go ahead and note the other expenses as well. And let's just go ahead and fill those in even if we get out of order here. So the actual travel expense for May was $19,000. Other was $34,500. Now travel we can see is entirely variable, $600 per customer served. So in the flex budget, travel expenses should have been $600 times the actual number of customers served of 35, or a total of 21,000. Over in the planning budget would have been the $600 times the expected number of customers served of 30, for a total of $18,000. Other expenses, we know the actual amount again was the $34,500. That's entirely fixed at $36,000. So in the flex, we wouldn't have flexed it at all. It would just be that same $36,000. And of course, it would be $36,000 as expected in the planning budget. Let's take a look at some of the questions here to make sure we don't forget any. Travel expenses in the flex budget, we already took care of that, $21,000. Other expenses in the flex, $36,000. Net operating income, let's go ahead and do that. So total expenses, we'll get a subtotal there just because we can. This is the total of just our three expenses here. I'm actually going to paste that formula across since the cells are the same. And then our net operating income just becomes the revenue minus those total expenses. $18,500 in the actual result. The flex, which is what they asked us first, there's our revenue minus our total expenses, or $29,500. And then over here in the planning, revenue minus total expenses, or $13,000. So if I've said what net operating income would be in the flex, well, there's $29,500. Next, we're going to look for all of our variances. So the first one they're looking for is a revenue variance. And let's remind ourselves, I'll give us a little more room here, which differences cause which variances. So any difference between our planning budget and our flex budget has to come about because of a difference in activity between what we expected to do and what we actually did. Right? So those are our activity variances. Over here between our flex budget and our actual result, that's got to come about because of a difference caused by something other than a change in volume or activity. So a change in the cost of our inputs, change in the price we're able to charge customers if we're thinking about revenue, those types of things. So that's got to be a revenue or spending variance. So they asked us first about the revenue variance. Well, that's our revenue line between our actual and our flex budget. So we can say, well, what's the difference between the $175,000 in the flex and the $160,000 in the actual? And that's $15,000. And let's give ourselves an extra column here. Apologize if you're kind of typing along, to just note whether that thing is favorable or unfavorable. In this case, since the actual result is lower than the flex and we're on the revenue line, we'd say that's unfavorable. Let's keep in mind what could cause this type of variance. It's got to be in the amount we're able to charge customers, what we say we've earned from customers. Can't be related to the fact that we had a change in volume because we've already accounted for that going from the planning to the flex. It's got to be something else. Right? We gave people a discount for some reason, maybe. I'm also going to give us an extra column over here so that we can do the same thing for our activity variances. I know this is jumping around a little. Let's go ahead and take care of that activity variance now that we've got space for it. So if we subtract the 175 in the flex minus the 150 in the planning budget, we've got a difference of $25,000. Now the flex budget revenue is higher than the planning budget revenue, so we'd say that's a favorable variance. Remember, that doesn't mean we've necessarily done anything amazing in terms of what we're able to charge customers, but we have served more customers than we expected. So that's potentially a good sign. Back over here to the questions, number 7 asked what the spending variance was for our employee salaries and wages. So again, spending variance not caused by a change in volume or activity. So it's the difference between the actual and the flex here. We can see that's $500, but just to be explicit, the 88,500 minus the 88,000, there's $500. Now it's lower in our actual result than the flex, so it's lower than it should have been, which for an expense means that's favorable. Maybe we save some money on payroll taxes. Right? The county or the state or the federal government gave us a break on something maybe. Let's go ahead and do the rest of our spending variances for expenses while we're here. For travel, we've got the $21,000 in the flex minus the $19,000 in the actual, or $2,000. Again, it's lower in our actual results. We'd say that's a favorable variance. For some reason, travel cost less. Plane tickets were cheaper. It's pretty timely given the current circumstances with the coronavirus, right? In terms of our other, even though that's a fixed cost, we did have a variance. So 36,000 minus the 34,500, or 1,500. Again, that's in the favorable direction. So these other expenses that are supposedly fixed, we spent less on them than we quote-unquote should have given our actual level of activity. Might as well point out while we're here, we can't ever have an activity variance for a fixed cost because we don't flex those in our flex budget. So we'll never have an activity variance for those. Okay, total expenses, we might as well round this out here. We've got a difference of 4,000. We already know that the individual spending variances were all favorable, so that's got to be favorable as well. Just the sum of those other three if we wanted. And then in terms of net income, we've got the 29,500 in the flex minus the 18,500 actual. That's $11,000, and that's in the unfavorable direction. We could also figure that out by netting the $15,000 unfavorable revenue variance with that total $4,000 favorable spending variance. $11,000 unfavorable at the income line. Let's go ahead and finish our activity variances then. We've already taken care of revenue. So for salaries and wages, 88,500 in the flex minus 83,000 in the planning is 5,500. Now that's higher, so we would say that's unfavorable. But again, it's important to remember what that direction means over on this side. All it means is we served more customers than we thought we were going to. So unfavorable is a little bit misleading sometimes. We would expect our expense here to be higher given that our activity was higher. It doesn't mean we haven't controlled costs well. It doesn't mean we've done anything wrong in terms of controlling those costs. Similar idea for travel. We'd expect it to be higher given that activity was higher. So $3,000, we still call that unfavorable, but again, it doesn't mean we've done anything poorly. Total expense line, we can get a total here, 145,500 minus the 137 in the planning budget, $8,500 unfavorable. And then again at the net operating income line, 29,500 in the flex minus the 13,000 in the planning budget, and that 16,500 is favorable. Right, we had a $25,000 favorable activity variance at the revenue line minus the 8,500 unfavorable at the expense line, and that would net out to a $16,500 favorable variance at the income line. Again, all this says is that things lined up just as we'd expect given that we had greater than expected activity. These differences only relate to that change in activity. Recapping on this other side then, all these revenue and spending variances, they come about because of something other than a change in activity. So the cost of inputs, if we're thinking of our expenses, maybe the price we can charge if we're thinking about revenue, and related things like that. And so with that, we've finished up the foundational 15 here.